Sometimes our clients ask us, how do we take advantage of different tax benefits? Or my employer is offering this, should I take it? One account that's really helpful is an HSA, a health savings account. Let's talk through it, explain what it is, some of the rules, and why you would want to do it. So an HSA, that's essentially just another account. Think of like your IRA or your 401k. It's very similar. HSA stands for Health Savings Account. It's available to those that have a high deductible health plan. So if you have a high deductible health plan, you could set up an HSA. How does it work? How do you put money in? How do you take it out? Similar to your IRA, there's limits on how much you can put in. But in this case, there's no limits on how much you make. So an individual can put in $34.50 per year. A family or those filing jointly can put in $6,900 a year, and these are 2018 limits. And if you're over age 55, a little bit different from a 401k or IRA, it's not 50, it's 55, you can put in an additional $1,000. So all that money is going into the account. It's being deposited right there. It can also be invested and grow just like any other account. And then eventually you're going to take the money out, and there's some rules there. So this account's really special. It has it's kind of like a triple play effect. The money that's going in is tax deductible or pre-tax. The money that's growing is growing like a Roth IRA, not an IRA. It's never taxed, it's tax-free. And eventually when you're taking distributions or money out, if you're using it for medical expenses, health savings expenses, it's tax-free as well. So money going in is tax-free, tax deductible, pre-tax. Money in the account is growing tax-free, and money coming out, if used for medical expenses, is tax-free. When can you put money in? So you have until the end of the year, and then until April 15th to put it in for the prior year. Some great advantages and some rules now about this is, unlike an IRA, there's no RMDs. So you never have to take money out. It can actually accumulate and grow year to year to year. If you're over age 65 and you're signed up for Medicare, you can't put any contributions in any longer, but you can always take the distributions out. Another nice rule here is you can set up beneficiaries. So maybe you want to pass this along. If something happened to you, you pass this along to your spouse. She inherits this or he inherits this just like it is an HSA account, and uses it for their medical expenses, their respective expenses. If it was a non-spouse, a child or a family member, they essentially receive this account and they receive it all as a taxable distribution. It just becomes like their individual or joint account. And one other consideration is, what if you need to use this money? What if you put money in and realize, hey, I need it for some other reason? If you take the money out and you use it for non-medical purposes, you pay income tax, and there's a 20% penalty if you're under age 65. Once you're over age 65, there's no 20% penalty. But as long as it's used for medical purposes, this is a great account. It actually encourages those to save for the future for future health expenses. If you have any other questions about this, or we can be helpful in just explaining some of this in more detail, please let us know. We're always happy to help you.